1.2c changes the previous question slightly. The sister still bought the computer 2 years ago for $3,000. It's still got a current market value of $1,800, which she gives to the business. What's changed is that the business, Superior Appliances, is now going to give the sister $1,500 cash for the computer. So the question we've got is in two parts. Does Superior Appliances have an asset, and if so, what value should it be recorded at? So again, to answer that, we're going to go through the three criteria that make an asset. The first part is, does the business have a resource it can control? In the previous question it didn't, because the computer had been loaned. In this case it does. It actually now legally owns the computer, given that the sister has been paid for it. 2, was there a past event or transaction? In this case, again, we'll say yes. Giving the sister $1,500 and the sister actually transferring ownership of the computer to the business does mean that there was a past event or transaction. And 3, was there a future, or will there be a future economic benefit flowing to the entity? In this case, it's true. It was also true in the previous one, but the business will be able to use the computer in order to run its daily business, so that is true. So in writing that, we're going to define and relate at the same time and say, yes, we do have an asset because there's a resource controlled by the entity. The firm actually now owns it. 2, there's a past event, in this case giving the sister $1,500. And lastly, there will be future economic benefits in being able to use the computer in the operations of the business. The second part of the question was, okay, if we have an asset, what value should it be recorded at? So we've got the $3,000 that the sister bought 2 years ago. We've got the $1,800 that she valued it at and gave it to us. And then we've got the $1,500 that we paid her. So it depends how you which theory you want to use to answer this question. I'm going to use historical cost. So in this case, I identify it. I'm going to define it. The historical cost states that the item should be valued at its original purchase amount. Now we've got to relate it. So we actually have two purchase amounts. We've got the $3,000 the sister paid and the $1,500 that we paid. So we're actually going to go with the $1,500 that we paid, because the $3,000, while it's the historical cost for the sister, she's a separate entity. So kind of combining the entity principle here, we're actually just interested in the business as an entity. So we'll just use the $1,500 because that is the price that this business paid.